Today's video, we're going to talk about something so simple, right? And it's something that you should be able to identify just by looking at, and it's called equal highs and equal lows. And we're going to be talking about equal highs and equal lows in terms of looking for reversals in the market and giving us opportunities to enter our trades. So on my chart, you are going to notice a few different things. I have my candles, right? Which I just also call price action snapshots because this is telling us what's happening in the market. You'll notice that the market will be going up and then it'll go down, then it'll go up and then it'll go down, it'll go up, it'll go down, it'll go up, it'll go down. And this will just be happening forever. Now, when the market is going up, you'll notice that there will be green candles, and green candles are represented by the buyers in the market. Versus when the market is going down, this is letting you know that the market is selling and that there are more sellers in the market. And just because there's a downtrend, right, like here, it doesn't mean you won't see any green candles. And just because there is an uptrend, like here, it doesn't mean that you won't see any red candles. But it is important for you to be able to establish the trend because this is going to help you determine whether or not you should be buying or selling. Now, these two lines I have up here at the top of my chart, the top one is the 50 EMA, right, which is a blue line and it's a moving average. And the purple line is the 20 EMA. Now, EMA stands for exponential moving average, and it just lets you know what the trend of the current market is. So you'll notice that if you find the candles above both of your trend lines, right, as in the case here, you'll notice that you will have more opportunities to buy or that you should focus on buy opportunities. We see candles above the EMAs, we see price going up, right? And vice versa. If you see candles below both of the EMAs, this just letting you know that price is above average and you should probably focus on sell opportunities. Now, another thing you'll notice on my chart is my momentum indicator, which is represented at the bottom. And this is another indicator that I use to give myself this simple strategy. So simply put, if you are looking for buy opportunities in the market, you're going to want to make sure that the candles are above both of the EMAs, which is number one. You're also going to want to make sure that the momentum is facing up and above zero, right? So in the case of right here, where are we? In the case of this candle here, right, we can see that the candle was above both EMAs, and we can also see that the momentum line was above zero, letting us know that that was a great opportunity to buy. And then over here, we can see that the candles were falling below both of the EMAs, and then the momentum line was below zero, right? So that's a pretty simple way to start to look at the market and to help you determine what your bias is and if you're going to enter the trade or not. Now, a lot of things that people typically have problem with are, okay, where do I get in? Where do I get out? Where do I get in? Where do I get out? And today we're going to be talking about a simple concept called equal highs and equal lows, which is going to be pretty simple to spot. So I'm going to go ahead and turn off my indicators just so that we can look at the naked chart and only see the candles, because what you will learn is that trading is all about price action. No matter which indicators you decide to look at, trading is going to always be about price action. Is the market currently going up? Is the market currently going down? What are the volume of buyers in the market? What are the volume of sellers in the market? And we need to know when the trend is going to change so that we don't lose too much money if the market decides to go the other way, or so we could find a better entry point and to catch more of that move. So again, we're going to be talking about equal highs and equal lows. So this will be an example of an equal low, right? An equal low just means that price came down to a certain point one time, right? It came down to a certain point another time, right? And if you see that price is coming down to the same point or close to it 2 to 3 times, that's going to be considered an equal low, and it's going to be a sign that the market could be reversing. So we have an equal low here. We have an equal low here, right? This is also known as liquidity because we see our wicks there, and then we see that the market actually took off in this direction, right? And vice versa for a sell, you will look for equal highs. This is another example of liquidity and equal highs. We see that the market had a rejection. We see that the market had a rejection 1, 2, 3 times, and then there was a small reversal. Right here, we see equal lows. And it's not really too hard, guys. It's exactly what it sounds like. Do you see at least 2 or 3 equal highs or equal lows? So here we see 3 equal highs, and then we see a sell. Here we see 2 equal lows, and then we see a buy, right? Here we see 3 equal highs, and then we see a sell. Here we see about 3 to 4 equal lows, and then we see a buy. So equal lows are going to give you an indication that the market is going to turn around and buy, and equal highs will give you an indication that the market is going to turn around and sell. So I'm just going to go back into the past a little bit to show you guys another example of this, right? Just because it is pretty simple to see. And once you really see it, you can't unsee it, you know? So let's just say we were in the market right here. We have 1, 2, 3 equal lows, and then we have a push up, right? Then we have 2 equal highs, then we have a push down, right? Then we have 2 equal lows, then we have a push up. Then we have 3 equal highs, and we have a push down. 2 equal lows, push up. 2 equal highs, push down. 4 equal lows, push up, right? So this will keep happening over and over and over and over again. Now, let's just say you are in the market right here when this candle happens, right? You don't automatically just want to get into a sell, right? You want to make sure that you get at least 2 or 3 of these rejections in a certain area before you get into the trade. Because look, we had 1 rejection, 2 rejection, 3 rejections, and then we were still able to get in for a sell down here. Let's just say you would have gotten into the market. I mean, if you would have came into the market when this candle was forming, we see that a new low was created, but now we would want to get that rejection 2 and at least 3 times, right, before we actually take the trade. Same thing, equal high being formed. You have 1 rejection, 2 rejections, 3 rejections, sell, right? So I would say 3 is a safe number. Sometimes it happens on 1 rejection, as we can see. Oh, sorry, y'all. Sometimes it happens 1 time, which we can see here. We had 1 high, and then we had a sell, right? But just to be safe, just to manage your risk a little bit better, you do want to see those equal highs or equal lows. So here's another great example for a buy. We have 1, 2, 3, 4 rejections before we actually get a push up. Let's look at this area. We have 1, 2, 3 rejections before we get a push down, right? Let's look at this area. We have 1, 2, 3, 4, 5 rejections and then a push down, right? So it's very easy to see it. And once you see it, I promise you, you cannot unsee it. You cannot unsee it, guys, and your trading will just become easier and you'll become more profitable if you really internalize this and practice it. Now, what can we see happening at the market here? Right? We see that we've already had 1, 2, 3, 4, 5 rejections and then a sell. We've had 1, 2 rejections, then we had a buy. And it looks like, if I'm not mistaken, we have 1, 2 rejections, and it looks like the market is going to be going down again, right? And as far as where you would want to set your stop loss or take profit, when you do find that you have these equal highs forming, right? If you're going for a sell, your stop loss will be 5 to 10 pips. Let me see if I can draw this out a little neat. Right? You want to do 5 to 10 pips above where the equal highs are. Right? 5 to 10 pips above where the equal highs are. And you would want to set your TP where the next, right, depending on how many pips you're trying to get, you would want to set your TP where the next equal lows are. So you can go there, you can go there, or you can go here. Because there's more equal lows here, I probably would do it somewhere around here. So it'll go from here to there, and that'll be a pretty decent trade of about 20 pips. And I'll go back into the past a little bit just so that you can see that by following that formula, by setting your stop loss at the equal highs or equal lows, you should be in the clear. It's not guaranteed, nothing's guaranteed in trading, but just from those examples. So let's look here. We see all of these equal highs, right? So our entry point would have been somewhere around here, and our stop loss would have been somewhere up here. And as we can see, the candles never reached that area. It actually did sell as projected, and then we could set our TP where previous, right, where previous liquidity was, which would be here or there. And let me see if I can draw this line all the way across. Yeah, you'll notice that the market eventually did hit the TP because it revisited the previous low. So again, I'll just scroll back again, and I just want you guys to recognize and be able to see visually that when you are seeing these equal highs and equal lows, the market is going to turn around. And I will just add the indicators back for a second so we can combine everything we learned today. And you guys can really get a full picture on how this really makes sense. So we're going to look right here. So we have our 1, 2, 3, 4 rejections and our equal highs. So we would have gotten to our trade somewhere around here, right? We would have set our stop loss above the previous highest high, which would be right there, right? And as we can see, we would have not gotten stopped out of that trade. We see that we saw the rejections at the top and the market decided to go down. And what we would do is we would set our TP. We would set our TP where the previous lows were, which would be here. And we can see that this trade would have hit TP, right? Now, when I add my indicators back to the chart, what we should also notice is that these candles should also be falling below both of the EMAs, and our momentum indicators should be below 0 or facing down. So let's go ahead and add our indicators back just to confirm if what we're seeing is correct, because remember, your indicators are just confirmation as to what you're seeing. And then we literally have everything that we talked about at first, plus those equal highs and equal lows. So we have our candle, and let me just delete some of this stuff. So we have our candle crossing below both of the EMAs. We have our MOM indicator below 0, and we have the rejection of those equal highs. So this would have been a great trade setup for a buy. And yeah, guys, I believe that's all I have for you today. I really hope that this was helpful and really straightforward when it comes to understanding market structure.